All right. We're back here on the Investor Coaching Show. Paul Winkler, Ira Work, and Evan Barnard. Talking about money and investing. And the news of the week is one of those things that we get into here, as well as questions. And the way you get a question in, it'll eventually be where you can do this live. But, Michael's off on vacation. I couldn't even ask him. So we're going to throw him under the bus. Stuart, you got thrown under the bus last time, right?
I did, yes.
Yeah, so, you're off the hook this week.
Thank you.
It's Michael gets thrown under the bus. Well, so we got this technology, and I just don't know how to use it yet.
I'm just going to let you be the bus driver. And wherever you want to take it, that's where we'll go.
All right, I like it. But we have the text line, and you can text the word STAT to it and get on our list of people that get videos when I see something crazy and wild going on that needs to be communicated right away via video. You text the word STAT to 615-808-8543. And that is something you can also text questions for the show that way. Another way you do the questions for the show is paulwinkler.com/question. That's another way to get those questions in there. And then what we do is do a segment on, and we'll send you the answer to the question, a very detailed answer to your question, as a matter of fact. And we'll have some of that coming up as the show goes on. There was a segment on a financial channel regarding CNBC was talking about the meme stocks coming back.
Yeah.
And I just thought that the conversation was very illuminating as to how the investment industry and how people in the investment industry think about these phenomena regarding investing in individual stocks and what has been happening. So I'm gonna hit the first segment right here is talking about meme stocks being the risk off excitement as they called it.
Meme stocks are making a comeback this week. Stocks like GameStop, AMC, they're all up to their highest they've been now in months. But is this growth really sustainable? Join us right now is Tom Sosnoff. He is Tastytrades founder and co-CEO. Tom, what is going on here? Can you explain this?
I wish I could. I don't know, except it's a good thing, Andrew, when we get a little bit of action in meme stocks. It brings everybody back into the market. It's good for engagement.
But what do you ascribe this move to?
I think it's a combination of a lot of risk off in the commodity markets and a lot of excitement about, just the recent rally. We've had a huge rally over the last 2 weeks. And there's been, a huge decline in implied volatility. There's been, they've crushed a lot of the a lot of money went into things like, wheat, corn, soybeans, crude oil, a lot of selling in the bond market. And I think it's just think of it more like a sector rotation into things that people like to trade. They like to there's a lot of noise, and traders love noise.
Yeah. So what is this guy basically saying? Hey, you know what? We buy this thing when it goes up, commodities, we buy that, it goes up in price. We didn't pay the price that was when it was down here. We paid the new price, which was up here.
Right.
Whoever owned that thing before is the one that benefits. Right. So then what we do is we go, oh, well, that excitement's over. It wasn't nearly as big of a deal. Oil went up a lot, and then it came back down, right? And they bought it at that high price, paying 120, 100. I forgot what was the highest it was. It went up to, and then you got all the commodities. And he says, with the risk off trade. So what they're doing is saying, well, risk off. We lost a bunch of money, so we better get off of this deal.
Yeah, two things. One, I'm not sure I would want to invest with someone whose business is Tastytrades.
Well, that's...
Let me start there.
that goes without saying.
But the marketing notwithstanding, I actually totally challenge his premise. Now, I have no data for this. This is purely just anecdotal of knowing the industry some. Mm-hmm. I don't see the individual that is going risk off on commodities is the same person that's investing in meme stocks. I kind of picture those as two very different groups of people.
I don't know. I think they're all speculators.
I think their behavior may be very similar.
Yeah.
But, the person that says, okay, whatever, it's cooling off in corn and lumber, isn't the 25-year-old buying NFTs and meme stocks? I mean, that would really be interesting to know.
I know. Well, I figure a guy with a company called Tastytrades probably watching who's buying and selling and may actually know, and it may be.
Could be.
Yeah.
No, I would tend to agree with Evan on that because the younger kids are looking for what's cool and what's hot and sexy, where I think having had a client that raised corn, he used commodities to offset a bad drought.
Yeah, there can be people that actually use it because it's their business. But I think I don't know, guys. I think
that'd be interesting
a lot of
actually to know.
I think there are a lot of younger people that are doing crazy things.
Wow.
So he talks about AMC Mania, which is kind of funny actually. So basically, let me go back to what he just said there. He says, so now what's happened is they're going, well, that thing screwed up. We really messed up with that. With commodities. And now what we're going to do is we're going to get back into this other thing again because, that's the hip thing to get in. And it's just like no discipline. It's one thing to another. And what is this guy's response? But, well, it's good, because it gets some trades going again. Right?
Yeah. His joy was that investors were engaged, not that they were making money.
Right. Perfect.
I mean, that was just really
said. Well said.
Wow.
Yeah, well said, Evan. Okay, so here's what he talks about AMC. This is kind of funny. So AMC, theaters and things like that, right?
Yes. And so
tell me about the AMC apes. We're looking at a screen now. That stock's now $29.84. Yeah. I don't even know if there's going to be a movie theater company when it's over. They're going to be in like all sorts of other investment. I don't even know what it's going to be. It's going to be like a conglomerate. I don't know what it is.
I mean, you and everybody else. I mean, I looked at the stock at $29. I mean, I think it traded 200 million shares yesterday. I looked at the stock at $29. I mean, I think of it just in terms of, I'm an opportunist. So I think of it in terms of, okay, it trades a lot. The option markets are tight. There's huge volume. There's a lot of efficiency in there. And the expected move over the course of the next 15 days is $10 on a $30 stock. That's where the excitement is.
Expected
this
move.
Is not just DraftKings. We should just,
yeah. That's what the answer is. Yeah. That is the answer. The answer is you can't think of AMC fundamentally. You can't think of, hey, what are these guys going to do? Because they probably have no idea what they're going to do.
I mean, that is the line of the day right there. I don't know what's making this stock go up. They don't even know what they're going to. The company themselves don't know how they're going to make the business model work. I mean, that should tell you something right there.
Absolutely.
I mean, just insane. And, Joe Kern is always good for, a good laugh, right? You listen to Joe, and he's always the comic relief at the end of these segments. And here's what he had to say.
Meme stock mania, for whatever it is, whatever that means, it's just good for business. It's good for your business. It's good for our business on the trading side.
Though, what about?
Good for our business,
there's going to be some winners, but there's going to be a lot of losers.
Now, this isn't Joe yet, but
so you can
losing. I don't understand.
You can complain, you can complain about inefficient markets because then it's not fair. But when you have efficient markets and you can buy or sell each side a penny wide, you can't complain. Either you can take either side. So you can't argue about a penny wide market that trades 200 million shares.
I don't know, Joe. Joe and I love Bed Bath. Bed Bath is a meme stock now.
Right. No, I was trying to think of an analogy, and I couldn't come up with any that are okay for air. But basically, you're like saying, think of some terrible thing. It's like, wow, it's great for the emergency room business. A lot of people are in here. It's not necessarily great, Tom.
Exactly.
Yeah.
Here's this guy who is, and this is the industry, guys.
There's only a penny spread, but 200 million trades.
But we could get you guys buying and selling, and who cares if you get hurt and end up in the investment emergency room?
Right.
It's great for you. And he assumed that these guys on air, that they would agree with him. That was the funny part at the very beginning, right? It's great for our business. And he's thinking that they're going to jump on going, yeah, this is great for our business. Yeah. And I thought it was laudable, at least, that the guys on
Joe,
the TV show.
I can't say that on the TV.
Oh, I know. Yeah, that was good. Now, so when he talked about efficient markets, he made a comment about efficient markets. So, and that's an important concept of investing. It won the Nobel Prize. And it's the idea when you buy and sell things, you don't have to worry about, am I paying a fair price when I buy something? Because you have a seller on the other side that wants to get rid of it and would love to get as much as they possibly can. You want to pay as little as you can. And what happens is you basically both have a lot of information and you come to bear with that information And therefore, neither side wants to get ripped off, so things are properly priced. So anytime somebody comes in and says, hey, Paul, I'm thinking about putting some money in the market. Is this a good time? And I go, well, it's properly priced based on all knowable and predictable information is what we always say, right?
Right.
So he gets into efficient markets in this last segment here that I want to hit. And I just thought it was interesting what he had to say regarding this.
Let's just say, if that's pretend, if you think that the meme stock phenomenon is some kind of pretend land where fundamentals don't matter, you have to almost take it to the extreme. I don't know if it's the extreme, but then you have to say that the whole thing is pretend. And here we are. Is it all pretend?
Well, I don't think the whole thing is pretend, but I think that, you can question fundamentals. If you believe in efficient market theory, you can question fundamentals all the time for virtually anything. I mean, you have to kind of believe that everything that's known is pretty much in the marketplace. So what you're really hoping for is the opportunity to trade something that has tight markets and it's efficient. That's what people get. The whole business is about noise. And wherever there's noise, that's where everybody gravitates to, because that's what's exciting.
So what do you think about that guy? I mean, the whole noise thing, because Ira, you were shaking your head yes. Well, what was going through your mind?
Well, I think he's confusing technical analysis for fundamentals, where technical analysis is looking at the price as opposed to fundamental analysis, which looks actually more at the business model. And I think he's just kind of mixing that all together to say, well, you could believe in the efficient market, but yet you can still gamble and speculate.
Yeah.
So where my mind went on that, you have two different types of market efficiency, and people get those two confused. And, so the type of market efficiency that when people say, well, markets are efficient, many times people think, well, that means that prices are always right. And the reality of it is, no. When Fama was asked about that, he says, well, you have two big market crashes, and you got, the 1929, and then you've got the 2008, or the 1999, and now 2008. Well, it's about what you'd expect. And the idea being that markets are efficient, that it's always properly priced. Well, then that isn't explained away when we see a market drop a lot. Because then what we would say, well, see there it was mispriced. It was selling for way higher than it was actually worth in 1999. And when 2001, 2002 rolled around, that proved that prices weren't right. Or 1929 is another example that was given by Fama a lot. And, the reality of it is that you have a form of market efficiency which basically says that they are efficient, they are properly priced, but mispricings and it can be mispriced, but we only know it in hindsight.
Right.
When new information comes out and it says, whoa, wait, we were paying way too high of a price, but it's still a lack of information. So you have those two different types of market efficiency. And a lot of people go, well, no, they're not, because look, so-and-so actually predicted this crash and it ended up happening and they ended up being right. But it was actually a gamble based on a prediction about the future. But it was information that wasn't necessarily out there to be responded upon and wasn't built into stock prices. So and you have these two different forms. What it does is take a quick break, and I'll explain this a little bit more in a second because I've gone way over on this segment. You're listening to the Investor Coaching Show right here on Super Talk 99.7 WTN. Paul Winkler along with Ira Work and Evan Barner will be right back after this. All right. We're back here on the Investor Coaching Show. Paul Winkler, Ira Work, and Evan Barner. Yeah, so, I was just talking about something, and we'll move on from this, but I thought it probably needed a little bit more explanation. When you talk about market efficiency, and, why is there such a debate about this? If you look at mutual funds, I don't know what percentage it is, guys, out there that are, of money is in active management. Last time I heard it was like 90% of active.
85 or 90, I think,
still.
Yeah,
it's super, super high. Where people try to pick stocks, they try to time the market. They don't call it market timing. They call it tactical asset allocation. I mean, that's because they know that you are onto them, right?
They know they're not supposed. It's like your kids. Yeah, I'm going to a party, What kind of party? Oh, yeah, pizza. Yeah.
So there's one firm that's now calling it advance and protect strategy.
Oh, there you go. See? I mean, that is beautiful. Okay, so it is a form of market timing, but we will call it anything but market timing, right? Perfect example, Ira. So you have the efficient market hypothesis is the idea that won the Nobel Prize in 2013. And it basically says, and that's literally when we talk about that, we're talking about more of a weak form of market efficiency is what we talk about on this show. We've talked about it forever. It's the idea that all knowable and predictable information is built into stock prices. There is what is called the strong form, and if you hear somebody say, "No, I don't believe this stuff. I don't agree with it," and this is really, and you'll hear people say, "Well, you guys are wrong about this market efficiency thing," and we'll go, "Well, wait a minute. What do you mean?" Well, you believe that all information, public and non-public, everything is built into stock prices, and no type of information can give an investor an advantage over the market. And that's not true because you have insider trading. And you have what Congress has been doing, like we're voting on stocks that we can have actually influence over.
Right.
And, there are pieces of information, but it's technically illegal. Yeah. And the reality of it is, I guess somebody could have known ahead of time that technology companies were overpriced, but the reality of was that information wasn't public.
Right.
So you couldn't respond to it and benefit from it legally anyway.
Right.
So hence what happens is because there's enough information that could not be necessarily public, and maybe somebody thinks that they know something that's not public, right?
Right.
So hence,
expectations are always priced into the market.
Right,
yeah.
Right. So hence, that's why people get confused about the idea of whether markets are efficient or not, is because of those nuances in the terminology of market efficiency are such that we have weak, we've got strong, and we've got semi-strong. And, what happens is that most people don't realize that there are those nuances.
But there's something that I caught, I don't know who else caught it, when they were talking about the trading and the difference between the spread, the difference between what you can buy and sell the stock for, of being 1 penny.
Right.
But when they're trading 200 million shares, that trader who handles the buy and the sell for the two different people makes $2 million.
You can make some dough.
So if you're doing that on a daily basis, you're making a heck of a lot of money.
Yeah.
Now, the problem that I find is that none of the clients that we service can actually afford to trade 200 million shares at a penny to make $2 million a day.
No, it is a excellent point, Ira. And you look at this, and people were complaining about the companies gaming the trades, right? Years back, and you had that special on one of the big networks, and they said, computerized trading is remember that? Yeah. And that's what they were talking about is that, but actually what's happened is that they can't get a leg up. They make a lot of money, though, if they can get people to trade. That's all they need to do is get you to trade. Right. And they get you to go and gamble your life away, and they'll make money one way or another. Now, they used to be able to make even more money because the spreads were even higher back then.
Yeah, and I think it was in the second clip, actually, and then he revisited it when we went down this efficiency conversation as well, is when I was hearing him talk about it, I didn't picture him referring to it at all in an academic sense. To me, how he was using the term was, we can trade really fast, really quickly, and process a lot of trades in a short amount of time. That was, to me, how he was using the word efficiency, is just like when you see the old video of changing tires on a race car.
Oh, interesting. Okay.
Versus changing tires on an Indy car in like 3 seconds. I didn't think he was looking at it at all from an academic standpoint.
Well, the reason I took it from that it was academic was that he could do this and he knew when he was buying it, he was paying a fair price, and when he's selling, he was paying a fair price, and it was fairly certain that he could make a profit through the markup because he wouldn't get ripped off himself. That's the way I took it.
Well, yeah.
And you may be right. Yeah, I wasn't even thinking about it that way. Yeah,
well,
who knows?
I think
he's a scumbag, no matter what he meant.
Well, I think that's the reason.
Just say what you really mean.
Why? why we see all these ads for all these different investment companies saying no commissions.
Right.
Because the investor doesn't know that they're actually being ripped off between the bid and the ask, the spread of what they're buying and selling.
Yeah,
their
when
stock
it's free,
for.
you're the product, right?
Exactly.
There you go.
As they say it. Last thing, just before we head to another break, I don't know if you guys caught this, but there was some kind of bad stuff that happened in the crypto market. Check this out.
Welcome back to Squawk Box. Crypto hackers hitting a network that runs a popular online game to the tune of 9 figures. This is the Ronin network. It's connected to the game Axie Infinity. In a blog post, it lost about $615 million in the stablecoin USDC, as well as Ethereum. Makes us now the largest DeFi theft in history. Analysts saying that Blockchain Intelligence Group saying close to $17 million worth of stolen Ethereum has now already been transferred to exchanges like FTX. So we talked about sort of what's happening in DeFi, but this is actually an example of one of the big problems. Now, maybe it's just a journey. Those bulls would say it's just a journey. Bears would say it's an example of the real problem here.
Did you know there was a crypto game site?
I didn't know about this particular game site, but I think that this larger concept that the money can just like disappear is sort of a problem.
Certainly can.
Yeah, sort of a problem. You know, if it's your money, it's a really big problem.
Yeah.
I was like, wow, look at that. So you look at the risks that people are taking, and they just don't, I don't know that they recognize it.
You know, it's kind of funny if you think about that, because there's nothing backing this crypto stuff. And I say stuff because it's not currency. So there's nothing backing it. So it's just these accounting
Well, there's nothing
maneuvers.
backing the dollar either. I don't know.
Well, the government backs the
Henry.
dollar. And the dollar doesn't fluctuate 10, 20, 30%.
No, I know. But
it's
no, there is something backing the dollar,
Right.
and it's the good faith and credit of the U.S. government.
Correct.
Yeah.
So, but I find this to be really funny that there's nothing backing this crypto stuff.
Uh-huh.
They could steal something that there's really nothing there.
Right.
Yeah. Is it really a crime?
So you put your money, right? You put your money into this fake thing. It appreciates, and then somebody comes
If a
and
tree
steals
falls in
your
the
fake
woods,
thing.
did it actually make a sound?
I did read an article earlier in the week that
Yeah.
they're predicting that the U.S. government will actually come out with a form of cryptocurrency between 2025 and 2030.
Yeah.
And what's going to happen to all these other fake currencies?
It is something I brought up here on the show several times, that there are not only the U.S. government, but many central banks around the world are actually working on that. I forgot the number. It's a high number.
I would not be surprised if the government actually does it, because this way we really will not know how much money our senators and congressmen
They'll just create more ones and zeros.
Well, but there's another reason to do it, because what they can do is they can actually bypass a central bank, and they can bypass a lot of the systems like the credit card companies, and they can be the lender, the direct lender in the banks. They can be the direct lender straight to the public, bypassing the system. And quite frankly, that's one of their concerns about doing it. They don't want to disrupt the system too much. So that's one of the things that's holding them back from doing that, Ira. So yeah, you know, we talk about the dollar not being backed by anything, but there was an interesting article on that. Andy Kessler was talking about that, and talking about how, you know, the dollar, why is it the reserve currency? And it is because of the good faith and credit of the United States government. But there's also more than that. It is the American economy, and the strength of the American economy is partially what gives the dollar its reserve status.
Right.
And if Russia were to go and team up with China, the problem is it's not, they're really not big enough to do it.
Right.
Is what they were saying in this. It's not nearly, the economy is not nearly big enough for it to actually work. And the U.S., you know, he was saying it's time for the U.S. to figure out where China and Russia might have a tiny edge. You know, like, for example, pharma, genetics, and artificial intelligence, cyber warfare, and so on and so forth, and start to take some of that back. And then they said that the sanctions on Russia won't endanger the dollar right away. You know, the reality of it is that that, inflation would really run rampant for those countries if they started to dump dollars, and it would be a real problem for them. So it'd be like going, hey guys, we're going to try to get you, and they've got a gun aimed at you with basically the
barrel pointed
back toward them. Yeah, exactly. So yeah, it's probably not terribly likely, but there's a lot of stuff out there. People trying to sell their investments or their newsletters and things like that to scare people that the dollar is going to crash. It's going to be no longer the reserve currency. And there's a lot more to it than they're putting out there in those. And I've got a few emails that I've had regarding that and I'll probably talk about that a little bit later. I'll get into that. So we'll cover that when the time comes. Paul Winkler, Investor Coaching Show, and Evan Barnard here with me in Ira Work.